A deal is complete when a deal is closed. A deal is not complete when an LOI is signed. A deal is not complete when you're starting diligence, kind of through diligence, almost done with diligence. A deal is complete only when it is complete. And within the due diligence process, or within the process after the signing of the letter of intent, prior to the closing, there will be 4 primary battles that you fight and you must win. That's what we're going to talk about in this video. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market investment banking firm, helping companies generating $1 million to $20 million a year in pre-tax earnings or EBITDA to sell their companies and to secure capital. So as mentioned, we're going to jump into the 4 battles of diligence. That will be our title, 4 battles of due diligence. These are the things that are necessary to do and to do well to ensure that you get the right outcome, you get the deal closed. Not only just do you get it closed, but you get it closed on the right terms that you need. People say, okay, well, we have all of the economic terms of the deal lined up and agreed upon. That should be everything, right? Sort of yes, sort of no. So yeah, do you have the overarching value of the deal? Likely yes. Do you have the structure of the deal? Probably mostly. The transition? Probably not really. Stakeholder considerations? Maybe. But the 4 battles of diligence we want to dig into today, say the first of these, so this does bake into the valuation of the business, is the quality of earnings. So you may hear that, QOE, Q of E, lots of different ways of talking about that. That'll be in our upper left-hand quadrant here. And so quality of earnings is basically an analysis of your financial statements, of your historical financial performance. The buyer will typically send in an accounting crew, sometimes an outside firm, less often internal people, but depends on the situation, how big of a buyer it is. They will come in and they will look at all of your financial performance of the company. They'll look at all your financial statements. They'll tie them out to bank accounts, to tax returns, to look and see if all of the numbers jive. Now, inevitably, QOE will come back and the buyer will come to you and say, hey, we did our analysis and the EBITDA looks like it's, and they'll say, some percentage lower than what was given in the bridge, some percentage higher. They try to fine-tune every single add back, which ones they believe, which ones they don't believe. And look, it was a lot of that tackled in the negotiation for the LOI, yes. However, it's a more formal look at it. And then they will look at all of the financial statements to see if there's any odd variations, any changes in COGS, changes in input materials. They'll look at a million different factors and they will come back to you. And at least 1 out of every 10 times, they'll say, EBITDA is lower, therefore we want to restructure the deal. We want to lower the price. And the answer to that is usually no. And does that always stay at no? Not necessarily, but you have to be able to take a strong position in order to say, or at least in order to dig into what are they seeing, what is deviating. You have to analyze. If they poke holes in a bunch of things and say, this isn't right, this isn't right, this isn't right, you can't just say, okay, I guess you're right, we'll just take 20% off the deal. You have to say, well, let's prove out each of these because we've done our analysis, and that's why it's important to prepare when you go into the deal. But once you see the QOE, you want to review what are any of the deficiencies that have been highlighted. Are they legitimate? Are they not? And so the idea is you try to intelligently dispute, if you will, any deficiencies that are pointed out. And to the extent that there are any that remain, if the buyer says, we want to lower the price, our response is, or what will bridge any of these types of deficiencies is usually structure. So what I mean by that is if we have a deal where 90% of the deal is cash at closing, 10% of the deal is a 2-year seller note or a 2-year, an earn out if someone's staying involved or some element of equity rollover. If a buyer comes to us and says, hey, the quality of earnings was deficient for this reason, therefore we want to lower the purchase price by 10%. A lot of times what we'll do to bridge that is we'll say, instead of lowering the purchase price by 10%, let's take 10% more of the deal and put it in the seller note. Give a little bit of time to it, or we'll add in 5% more to the rollover, 5% more to the earnout. But again, we always say structure bridges value. And so if someone comes back with the quality of earnings saying some elements of it are deficient, we're not going to concede value. And if we have to concede something, we will usually look around for any other things that could be, a give without lowering the value. And you'd be surprised is, there's no nefarious actors that are going to be parts of our deals, but at the same time, people will ask for things, and you have to be comfortable or have someone in front of you who's very comfortable saying, no, we don't want to do that. Let's get creative and try to find another solution. And so that's battle number one. It's going to be your quality of earnings. Now, battle number two is going to be working capital. And so you'll see NWC. This is not a early 2000s wrestling federation, but I think that might have been NWA. I'm not sure. NWO. No, I'm thinking of early 90s rap groups. Notwithstanding, net working capital is the amount of cash, accounts receivable, accounts payable, netted against, that is left in a business. You can think of it as current assets minus current liabilities. Now, the challenge is, right, if you are running a business that you've owned for a long time, you probably leave cash on the balance sheet because it's your company, it's your family's company, it's you and a few partners, and so you leave excess cash in the business. And so if someone were to look historically and say, well, let's just take the average of the current assets minus the current liabilities over time, what has that been? And from our perspective, that is way overvaluing what working capital has to be. Again, we want to leave in a company, to the extent working capital is necessary to be left in a company, which it is in most deals, you want to leave what is necessary to run the business, not what has historically just been the average, what has historically been necessary. And so that's a huge distinction. And what I mean by that is that the whole idea of working capital is that if someone were to buy your company today, they could continue to run it profitably and not have to put more money out of their pocket into the business. And so really what you want to see is, how long does it take for cash to come in? How much cash comes in? When does that start to cover operating expenses and generate EBITDA? That's really what you want to look at in terms of ramp up time. And so we like to think of working capital in terms of sometimes a certain amount of months. We will look at historical working capital versus operating expenses when netting out cash in particular, and that's how we get to a normalized working capital. So remember, the battle to be fought in net working capital is not just to look historically at the balance sheet and say, well, how much cash has been left in this business over all this time? Because again, you might be just using it like a bank account. Why take it all out, put it somewhere else if sometimes you have to put it back in, but you've already paid taxes on it if you're an S Corp or an LLC. And so that battle over working capital is very, very important. It has to be done thoughtfully. And again, the analysis has to ultimately come down to what is really necessary to keep running the business in a profitable manner without deploying additional capital. That is the true fundamental definition of it, not just, hey, this looks like what your working capital's been for the last 24 months. But if I kept $1 million in the bank account of my business for 24 months, it doesn't mean $1 million of cash is necessary to run the business. It just means that's what I happen to have in there, right? It's like, you could have a Mickey Mantle signed baseball bat in your office. It doesn't mean that helps you get deals closed. It just happens to be the thing that you leave there because your office is a safe place to keep stuff, right? Stupid analogy, but you get the point. But working capital is a meaningful element of the diligence process and a battle that must be won to get to the right outcome. So again, QOE and net working capital have meaningful impacts as it pertains to the valuation of the business. And so it's a value. So when people say, you know what, the LOI signed, we're really squared up on value, not quite, because you want to keep the value through the QOE and the subsequent discussions, and you want to keep the working capital realistic and get the cash, the excess cash out of the business. Now, third element is going to be the transition agreement. So the transition agreement will indicate what it is that you have to do for how long and what your roles and responsibilities are. Now, you did negotiate that as part of the LOI, as you would if you had someone representing you correctly, to say, okay, for how long, what responsibilities, what is that going to look like? But the transition agreement ultimately is the document in the definitive documentation. So the purchase agreement, the purchase agreement, any leases, things like that. The transition agreement needs to be whether it's a separate document or fused into the purchase agreement, we usually like it to be a separate document, and it will outline, and you want it to outline specifically, these are the roles, these are the hours, these are the duties, these are the responsibilities. And break it down in a painstaking manner, because trust me, in business, the greatest illness people suffer from is amnesia. And so you don't want anybody forgetting exactly what you agreed upon. If you said, I'm going to spend the next year helping you transition the company such that I am working on keeping a few of the meaningful large client relationships. You don't want someone saying like, "Hey, Bob, you know what? We really need someone out there, chopping wood and laying bricks all day." You want to do the things specifically you agreed to. You don't want there to be any creep in that scope unless you want to expand your role. But that's why it's important to crystallize it in the transition agreement. How long, what duties, what responsibilities do you have? And even more so, the inverse, what responsibilities do you not have? And lastly, we're going to have the purchase price allocation. Now, the purchase price allocation is basically how are you actually selling the business? In the sense of, we've made separate videos about it in its entirety, but most business transactions under $100 million are going to be an asset purchase. So you're not necessarily selling the shares of your company, but you are selling all of the assets. So you have an entity, you're selling all of the assets out of that entity, and someone else is taking all of those assets and putting in cash. Now, they're not taking every single asset. They're going to take most of the things. Now, they'll leave behind certain liabilities, usually kind of latent, any kind of like potential lawsuits and things like that. But there's, in the schedules of the purchase agreement, there'll actually be a list of the assets they are buying, a list of the liabilities or assets they're not buying. And so they are, for the most part, buying everything out of it. Now, that being said, if someone is paying $10 million, $100 million for a company, let's just use $20 million for a company. And, they say, okay, well, we're going to buy your inventory, we're going to buy your equipment, and then I guess the rest is just going to be goodwill. What's in addition to that? So if they deem the equipment to be worth $5 million and they deem the inventory to be worth $5 million and the rest is goodwill, well, goodwill is going to be taxed at 20%. Again, the purchase price allocation has most to do with taxes. So let's say goodwill, you're going to have 20%, basically federal long-term capital gains. The inventory is going to be taxed at nothing, 0. And the equipment is going to be taxed, or the FF&E, as they call it, furniture, fixtures, and equipment, so we'll move that again, is going to be taxed at the ordinary income. However, it's the ordinary income based on whatever the depreciated basis is. That's something for accountants to figure out, but the idea is that it's ordinary income. And so, that's 35%, 36% based on the current regime. But nonetheless, the idea is you really don't want to leave it to chance of how the purchase price is being allocated. Buyers can be somewhat flippant about it sometimes. There can be certain advantages for them to allocate a certain way. But really, if you are selling a company, again, in the situation where you said, $5 million is inventory at nothing, $5 million is FF&E at, let's say 40%, so I can do the math in my head, right? Then you're only picking up $3 million out of that. And then if 10 million is at this 20%, then you're picking up 8 of that. So you say 8 plus 3 plus 5 is 16 million. So out of the 20 million purchase price, you're going to keep 16 million. So you're going to effectively pay 20% tax across all things. It doesn't think of state taxes. There's other things that get involved, but nonetheless, that's kind of the simple way of thinking of it. However, so if we said, you know what, the FF&E is 2 million. We think the inventory is worth 8 million, and the goodwill, we'll still keep it at 10 million. So again, you'd pay 2 million in taxes on the goodwill. The inventory, nothing. So again, you'd have 8, there's 16. And then based on the 2 million of FF&E, even at 40%, you're talking of 0.8, so 1.2 million. So again, now you're taking 17.2 million out of the initial 20 because you've allocated it differently, right? And it gets more complex than this, but it's the general concept is you have to kind of fight for what that allocation should be that's optimal for you as the seller. So to wrap all of this up, the key variables of a transaction, the value, the structure, the transition, are things that are hammered out. And if you have the right kind of people you're working with, hammered out pretty well during the negotiation getting to the LOI. However, once you hit diligence, some of these zombies are going to come back, and there's going to be some battles to get from the LOI to closing, and you have to be vigilant about it, and you have to really look for the details to make sure that you are actually getting the result you want. So that's the thought. 4 battles you're going to fight during diligence that you must win to get the optimal outcome. Hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.